A market is crashing. Screens are red. Sirens are silent, but you can feel them. Somewhere, a trader smiles. Not because he's cruel, because he's prepared. That's the uncomfortable truth. Every crisis looks chaotic, but the money doesn't move randomly. It moves along the same tracks, again and again. Why does this keep happening? And why do the same people always seem to end up richer? Right now, prices are swinging, inflation is sticky, and households feel squeezed. Millions check their bank balances. A much smaller group checks their opportunity list. Here's the system, simply. First, something breaks. A pandemic, a war, a banking panic. Supply lines crack. Fear spreads faster than facts. Then markets fall. Fast. When prices drop, ordinary people do what they're told is responsible. They sell to avoid losses. They hold cash. They wait. At the same time, central banks step in. They cut rates. They pump in liquidity. They stabilize the system. That sounds neutral. It isn't. Lower rates make borrowing cheap. Cheap money flows into assets, stocks, real estate, businesses, and financial instruments most people don't even know exist. Who owns those assets? Mostly the already wealthy. So here's the chain. Crisis hits, prices fall central. Banks ease, asset prices recover. Wealth concentrates. Quietly. Efficiently. Every time. In 2008, trillions were injected into markets. Wall Street recovered in years. Many families never did. In 2020, money was printed at record speed. Billionaires' net worth jumped by trillions. Rent still went up. To a saver with a bank account, this looks like stability. To an investor with assets, it looks like a gift. Picture a house in a storm. The rain pours equally, but only one person owns the roof. Now zoom in. A factory worker loses overtime. A small business owner hesitates to expand. A family delays buying a home. Zoom out. Across the country, asset values climb. Across the world, capital moves to where returns are highest, not where people are struggling most. The hype says crises are great equalizers. The math says the opposite. The mechanism isn't a secret conspiracy. It's incentives built into the system. Protect stability. Protect markets, and by extension, protect asset holders. And each time we save the economy, we also widen the gap a little more. But here's the quieter irony. If markets never fell, the wealthy wouldn't get these discounted buying opportunities. If money weren't cheap, leverage wouldn't work so well. So the system depends on crisis as much as it depends on calm. Which leaves a question that never quite gets answered. When the next shock arrives, and it will, are we saving the economy? Or are we perfecting a machine that only works for a few?